Today we have a guest from Japan, Jaika, the program. Today's speaker speak about the value of the company. I just give him word to start with the introduction of himself. Then today is a very essential and interesting topic. He will speak about it. So I hope it will be very interesting. Thank you. Thank you.
Yeah. Thank you very much for introducing myself. Okay, Assalamu alaikum everybody. My name is Kenichi YAMANA, and I come from Japan, and now working in the UJICY, that is Uzbek Japan Innovation Center of Youth, which is located in the Tashkent State Technical University in Beluni. Then today, thanks to the Banking and Finance Academy, which invited me to talk with you, so I'm very glad to see you all. And I would be most grateful if you listen to my talk today and then understand the topic, the value of company. And my talk today will be in line with the front display. But the same thing is distributed to as handouts. So you can see either the front display or in your handouts, whichever is okay. And you are free to take the handouts with you and go home. And the slides have both English and Uzbek languages. But I only speak English. So I think we have a translator today. She will translate my English into Uzbek. Then I'm not an English native speaker, so my English is not perfect, but I will try my best. Then try to speak slowly and clear to you. Then today's lecture time is limited, so let me go through my lecture until the end. And if you have comments or questions, please tell me at the end of my talk. And there will be a questionnaire at the end. So you will answer the questionnaire by your mobile phone, but I will explain it later. Okay. And before getting into the subject today, I want to introduce myself. Okay. I was born in Osaka and raised in Hiroshima and studied Japanese law at Kyoto University. Then if you have a chance to visit Japan, so do not fail to visit Hiroshima and Kyoto. Because in Hiroshima, as you may know, so they had atomic bombing 79 years ago. But you can see how the people got over the tragedy and then recover the beautiful city of Hiroshima as it is today. This is Hiroshima's picture. So in Hiroshima, you can see a beautiful coast and beautiful islands, and then along the Seto Inland Sea. And you will enjoy all the castles, and then famous floating shrine that is floating on the sea. And as well as a professional baseball team, and then delicious local food like okonomiyaki. Okonomiyaki is this. And then in Kyoto, Kyoto is the ancient capital of Japan. And you can see a lot of shrines, temples, and Buddha statues. Yes. And that were built over 1,000 years ago. And you will experience Japanese culture, like Gion Festival and the Geisha District, or kimono wearing, and the beautiful streets of Kyoto. So, just a moment. I'm a little confused. Okay. Kyoto University is a national university in Japan, established in 1897, about 130 years ago. They have a total of 10 faculties and 19 research institutes in the area of natural sciences and the cultural and social sciences. And 23,000 students are studying. So in particular, Kyoto University is famous for having 8 Nobel Prize winners from its graduates. So that is the most ever in Japan. He is the first Nobel Prize winner, Professor Yukawa Hideki. Then I joined Mitsubishi Bank in 1980, and in 1985, the bank sent me to the United States of America. And I had a chance to study American law at the University of Michigan. Michigan is located on the east side of the United States of America. Okay. And in Mitsubishi, in the University of Michigan, and I studied the contracts, antitrust, and cooperation laws. The person on the left-hand side below is a Professor Kamisal. He is my teacher of antitrust law. And after Michigan, I joined the Bank of California, which is in San Francisco and Los Angeles. And in California, this is San Francisco. In California, I was doing a credit enhancement, which is giving guarantee to the bonds issued by local governments. The photo on the left-hand side below is a convention center in San Francisco. So I gave financing for its construction by way of revenue bonds issued by the city of San Francisco and guaranteed by Mitsubishi Bank. And in Los Angeles, so I was doing a project finance for independent power plants. So I gave finance to a cogeneration, which produces both electricity and then byproducts such as steam. The photo left-hand side below is AES Thames. That is a coal burning power plant located in Connecticut. And I understand in Uzbekistan, the stable supply of electricity is an urgent issue for the entire country. And I think that given the abundance of natural resources in this country, I think there is a great chance to develop the power generation business in this country. Okay. Another occasion I worked in outside Japan was in London, England. So where I was the managing director of a securities corporation. So securities corporation underwrites and then buys and sells bonds and stocks in the euro market. And in London, I was responsible for the legal and finance and credit operation and internal management of the firm, as well as negotiations with the UK Financial Services Authority. So other than the United States and the United Kingdom, so I was all working in Tokyo, Japan, in many years at Mitsubishi Bank Limited. And then now it's called the Mitsubishi UFJ Bank. The Mitsubishi Bank has merged acquired several Japanese banks, as well as banks in the foreign countries in its history. And in the course of my experience, long experience in working in the bank, I often faced the issue of what is the value of company? And then, so how the stock price is determined, and why they sell and buy at that price. So today's lecture is an introduction of a company value. And for those who learned it for the first time, and provides examples of how to calculate the value of company, and help you gain a basic understanding of valuation. Okay, let's change the file. So what is value of company? Okay. The stock price and market capitalization. Yes, this is correct. It is really a value of corporation. But another one may say that salary and benefit received by the employees is the company's value. So probably he is an employee of the company. And then next person may say building and the equipment of the company. And that is true. So building and equipment have some values. And this is they are assets, the company's assets. Another one may say that contribution to the society and the environment. And this is true in a broad sense of a company's value. Last person may say quality and the price of products provided. So he is probably thinking of something like a KFC company, and then so he likes fried chicken. So all of these answers come from their own positions and opinions, and they all correct and reasonable. So how do you calculate its economic value? Company sales. Company sales is an amount of revenues, and that company generates by selling its products or giving services. And then large amount of sales gives them the chance to have a lot of profits and increase its value. For example, the General Motors, their yearly revenues is about $140 billion. And that is about twice as large as Uzbekistan's country's GDP. So the size of sales is definitely an indicator of company value. The company profit. Company profit is an amount after all the costs and expenses are paid. And profit is the only source of equity in the day-to-day operations. And it directly increases the value of corporation. But if the company is not doing very well, then the company profits may be very small or even disappear. So this is definitely an indicator of company's value. Bank deposit. Yes, this is a company's cash asset deposited with the bank. And then this is a liquid asset of the company. So it is very important when you analyze the solvency of the corporation. And it is certainly a part of the company's value. Building value is the cost of buying the building, which is listed in the balance sheet. And its value is depreciated each year, thus going down every year. But building value is definitely an important part of company's value. Inventory value. Inventory is the cost of buying the inventory, and which is also listed in the current asset portion of the balance sheet. And then it is expected that the inventory will turn into sales when sold as a product and bring profits to the company. So inventory is said to be a source of company's value in the future. And then stock price. Stock price is an indicator of company's performance, which is evaluated by investors. Each investor has his own view about the company, and someone sells and someone buys the same stock at the same price, which reflects all the public information and all investors' intentions. And the stock price will be discussed later in detail. So these are indicators, but other indicators as well. There are a lot of indicators and numbers which are relevant. So we will study how to find the company values with those indicators and numbers. Okay. This is a question. So is price for a thing? Is only one or more? Okay. This is an example. So you purchased a jacket from your friend for $150. And he said he had bought it at the shop for $250. But he would no longer wear it. But another friend has told you that the same used one is very popular and selling for $300 in the internet. Then, so which price is right and which price is wrong? So think of that. Which price is right, which is wrong? Or your friend probably should have sold in internet, not to you, and then get more money. So the $150 is the wrong price. Or on the other hand, the $300 in the market may be wrong because it's a jacket, used jacket, worn out jacket. So the jacket may not be that worth. So the answer is the next slide. There are no right or wrong prices. So $250 is your friend's book price or purchase price, and $300 is its market price. And you agreed with your friend to buy and sell it for $150, and it's your book price. So there are more than one prices for the same thing. Next question is this. A house owner sold his house for $100,000 to a real estate broker. The broker advertised its sale for $120,000. And you know that the standard monthly rent for a similar house is $1,000. So yearly, $12,000. And you think that you are sure that you can rent it out for 15 years from now. So is it a good investment buying the house? So what do you think? So you will not live in the house, but rent it out to a tenant for 15 years. You can make money by buying the house and leasing it to somebody else. So you need to calculate how much you earn in the future. And you need to compare with the buying price of $120,000. So what's your instinct? The answer is the following page. Yes, you should buy the house because you earn $180,000 by renting the house for 15 years. The calculation is $12,000 times 15 years is $180,000. So that is larger than $120,000, the buying price. However, one of your friends has come to you and advises you that, according to him, it may not be a good investment. Why? Okay. So I think many of you have already studied the present value and discount rate. Then probably you have been asked the question of which do you choose to receive, $100 now or $100 1 year after. Okay, you have a choice of $100 now or you have a choice of $100 a year after. So which do you choose? Can I ask somebody to this answer? I think everybody has the same answer, right? Yes. So you should receive $100 now. Why? So because you can invest $100 now, and you will have a return on that investment in a year. So in a year, after 1 year, you will have more than $100. That's why you should choose to receive $100 now, not 1 year after. So that is a concept of a discount rate and then a present value. So in this example of buying the house, the future income from the house is not the $180,000, but smaller than that if you discount that to a present value. The calculation is shown on this. And then the resulting figure is $116,546, so which is somewhat less than $120,000. That's why it may not be a good investment buying the house. Okay? This one. So why do they have different prices? Why do they have different prices? Okay, let's look back the slide 7. So slide 6. So this is a buying jacket example. So in this example, so probably your friend was looking at his purchase price of $250. And then because he already wear it, and then the jacket is old and then worn out, so obsolete. So that's why the friend sold it to you with $150. But in the market, it's very popular, and then it is selling and buying at $300. So each one has his own reason for the same thing, own reason for the price for the same thing. And in the example of this is a buying house example. In this example, probably the house owner was thinking of his costs or how much he paid to obtain that house. And probably that was less than $100,000. That's why he decided to sell it to a broker at that price, $100,000. And then the broker, what was the broker looking at? So broker was probably looking at the market value, market price, because it is his job, buy and sell the houses, and then make money by those trading of houses. But you are different. So you are looking at investing your money into the house. So you are looking at the future income that you will receive. So what I want to say is, yes, each one has his own reason for the price. And each one has different valuation of the same thing. That is what you learned so far. Okay, we go on to the next section, valuation approach. Okay, 3 approaches to valuation. So this is a basis of valuation. And then this slide is the most important slide in today's lecture. So please memorize and remember this. And then this valuation could be applied to anything. So not only to a company, but also real estate, or even to your personal things, like your car, furniture, TV, or mobile phone, or even your pencils. Pencil have an asset value, and then earnings value if it's lent to somebody, or it may have a market value if it's sold in the market. anything which have a value has three values by those three approaches. Okay, the first approach is asset value or book value. This is the price listed in the balance sheet or price when you purchased it. That is the asset value. So this is the cost of money that you have spent for obtaining the asset. And then I think you have studied the basic accounting. And then you know the assets are listed on the left-hand side of the balance sheet. And all of the assets are shown at their cost on the left-hand side. And certain fixed assets like a car or a building, houses, which have a limited service life. So they require depreciation or amortization, and their value are going down each year. Asset value only looks at the past, a cost in the past, and does not take into account the market value or any future elements associated with the assets. That is the asset value or book value. Second approach is earnings value. This is a theoretical price of all future earnings then that the asset will produce. It does not care how much was spent in the past or how much it is selling in the market. It doesn't care that. It only looks at the future. It only looks at the future when you receive the income from the asset. So this is pretty much a subjective approach because future income is based upon your expectation. So nobody predicts that you will receive how much you will receive in the future. So therefore, in order to not mislead yourself, you have to be careful and reasonable and even conservative in choosing basis for calculation for the earnings value. The third approach is market value. This is the price by which the asset is selling and buying in the market. So this is highly transparent and comprehensive because all public information is reflected, past or about the future, and is as long as known to the public. It's all reflected in the price. And also all investors' expectations are reflected as well in the market value. Okay, this is again an example. So 2 years ago, you purchased a new car for $10,000, and its life is 10 years. The straight line depreciation required and with no residual value. Now, the same used car is selling for $12,000 in the market. So it's often the case in Uzbekistan, right? So what is the asset value? Asset value is $10,000 minus 2 years depreciation. Is $2,000. Is equal to $8,000. Then, what is its market value? Market value is, yes, $12,000. Now it's selling in the market for $12,000 now. So they have two values. Okay, this is another example. You bought a house for $100,000, and you rent it out for $700 monthly, and $8,400 yearly for the life of the house. In this case, 25 years. So what is asset value or book value? Yes, this is $100,000. You purchased this house for this price. So what is its earnings value? Earnings value is, so you will receive $8,400 every year for 25 years. Is equal to $210,000. That is the earnings value. And if you take into account the present value with the discount rate, in this case 6% discount rate, then the calculation will be different. Then the resulting figure is $107,380. So I think I think you may think that this is very low. This figure is about half of the $210,000. But it is not surprising because the future income in the long future, like 20 years or 25 years, is a very small when discounted to present value. So in this case, the present value, if you take into account the discount rate and present value, earnings value is about the same as asset value. So which earnings value is right or wrong? How do you think? $210,000 is right, or $107,000 is right? Which is right or wrong? The answer is both are right. Both are right because earnings value is more or less subjective. So someone says that in his case that the present value is not relevant, but someone may say that present value is relevant. So both are okay, but usually in the financial world, the present value and discount rate is considered, except where in the extraordinary cases where the interest rates are very low and negligible, then the present value is neglected. Let's review once again. So what each value means. Asset value or book value means how much you have spent for and remaining in the asset. And earnings value is how much you earn in the future by utilizing the asset. And market value is how much you get if you sell the asset in the market. And then if you compare the asset value and market value, and then of the same thing, so you can get a hidden profit or hidden loss. That is called the unrealized profit or unrealized loss. And the unrealized profit or unrealized loss do not appear in the balance sheet. But once you sell the asset, then you will realize the profit or you will realize the loss. And that will increase your equity or decrease your equity. Okay. So we go on to the company valuation. So today is our main topic. Okay. Question is, what is stock price? Then why do some people sell and others buy at that price? That is a question. And in the previous slide, we learned that the stock price is an indicator of the company's performance. They evaluated by investors. But in the context of valuation, then what does stock price mean? Or what is the implication of stock and valuation? People sell and buy at that stock at the same price. Why? If all the people are informed of the same information, and if they think in the same way, so probably it seems strange that someone to sell and someone to buy the stock at the same price. It's why. And then there are many explanations for this question. So there is no single perfect answer. So I give my answer to you today, but this is only one of the answers. Okay? Stock price is a company's economic value that reflects all the information about the company and indicators of everyone who buys and sells the stock. Stockholder is entitled to the value of company. That is for sure, because they have a stock. But that is at least to the extent of the portion of the company's value. In other words, stock price is a portion of market capitalization, then which represents the company's market value. And people sell and buy stocks at the same price because someone believes in this answer. Some people think that the stock price will go down, and then the others think it will go up. That's why they sell and they buy. But why? Okay, so there are several explanations for this question, but the famous one, I'm going to introduce you the same famous explanation. That is, there is an inefficiency in the spread of information in the market. So there is a concept of efficiency and inefficiency. So inefficiency means that someone knows information, but the others doesn't know the information, or others doesn't care the information. Understand? So someone thinks this information is very important, but the other one thinks that this information is not relevant. So difference of opinion. So in the real market, so it is very, very mixed and commingled, of investors' views or expectations or opinions. They're very mixed. So therefore, in the situation, someone thinks that the price will go up, and then the other one thinks the price will go down. That's why they sell and buy the stock at the same price. And also, in the real market, I have experienced some, is that there is insider trading. I think you have studied the insider trading. What is that? And that is illegal. If found, that is subject to criminal penalties. However, in the real world, insider trading does exist. So this is my answer to the question, but I think you will have your own answer in the course of your study, the future. Okay, this is an example of a question. This is a very new one. Last month, January 24th, Tesla announced its fourth quarter results for 2023. That was about 2 weeks ago. Then, which were far below investors' expectation. And then its stock price plummeted by 12% on the next day. Plummeted is went down sharply by 12% on the next day. So why? So can you give the answer? Why the stock price went down sharply? Okay, the answer is people believe that the Tesla will not make future profits enough to maintain the current economic value of the company. Tesla, I think all of you know that Tesla is an American automobile company. It's growing very, very rapidly. But the last quarter of 2023 was not very good. But, market is always changing and then dynamic. So Tesla, at this time, they recovered some of the drop of January already. Okay. Next one. So this is a Japanese company's case. Last August, an acquirer announced a tender offer for Toshiba. Toshiba is a big company of Japan. And Toshiba shares at the price of 4,620 yen, and compared to the market price of 4,200 yen. So why did they offer a price 10% higher than the market price? You see, the 4,620 is 10% higher than 4,200. So why? think tender offer is often used to purchase a block of shares from the market. Okay. Then usually the tender offer's purpose is to eliminate other shareholders and then gain the control of the company. So that is the purpose of tender offer. Okay. The answer is like this. An acquirer believes that by eliminating other shareholders and gaining control of the company, he could run Toshiba in his own way and generate more profits to increase the company's value in the future. So the acquirer had a confidence that if he controls the company, the Toshiba will make a lot of profits, more profits than now. Then they're increasing the value of company. So that's why he could offer a higher price than the market price. So actually the tender offer, the acquirer was a Japanese domestic alliance, including Japan Industrial Partners, which is a private equity fund, and then with other major Japanese companies. And then the real purpose of this tender offer was that there was a foreign activist investors in Toshiba, and who had a large voice to the company, and they influenced a lot, to the Toshiba's management strategy. So then the acquirer thought that it's good to eliminate these activist investors and control this company. Actually, the tender offer was successful. Then the Toshiba will be unlisted and becomes a private company. So actually, I had a Toshiba's stock. I was a shareholder, but I didn't tender. Yeah. But anyway, that is another story. Okay. So we are learning. So what valuation approach do they take in what occasion? So what do they look at in the company to determine its value? So, okay, we skip this. Okay. Okay, we in this section, so we apply the three valuations to the company valuation. So in the context of company valuation, what is asset value? Okay, the asset value of a company is the amount of assets minus liabilities. That is the amount of equity on the company's balance sheet. So in other words, the asset value of a company is the asset supported by equity. So assets supported by liabilities are not counted. Earnings value of a company is not difficult to remember. Yeah? Earnings value is a present value of all projected future earnings of the company. So this is the same approach of a real estate example. So this approach only focuses on the future revenues. So whatever to invest in, company or real estate or anything, to calculate by discounting future income to its present value. And then you may have heard that the discounted cash flow method, or DCF method. I think you have heard this name. Then that is one of the earnings value. So instead of earnings, you will discount the future cash flow to a present value. Then you reach a discounted cash flow method value, present value. And this is often used in the mergers and acquisitions, and very important for acquirer, because cash flow is very important to acquirer. And cash flow is important for bankers as well, because bankers finance the transaction, and the cash flow is the focus of analysis. And the market value of company is what? It's a price of company's stock traded in the stock market. So we discussed the stock price in detail before already. Okay, this is an example case study What is asset value? So this is company Y, the balance sheet. So this company has a large current assets, $6 million current assets. But on the other hand, on the right-hand side, this company has a lot of liability as well. Current ratio of this company is 6 million versus 4 million is 150. So current ratio of 150 is very healthy. So the solvency of this corporation is good. What is this company's asset value? Okay, the asset value is $3 million. That is assets supported by equity. $3 million is this company's asset value. So this is not difficult to calculate. So as long as the company has a stable balance sheet, asset value is calculated very easily. What is a characteristic of asset value? Asset value is a static cost approach based upon the balance sheet. And asset value is pretty much objective, very objective. And then asset value does not take into account a market value of assets or unrealized gains or loss. So as I explained, unrealized gains, unrealized losses do not appear in the balance sheet. Then future earnings not reflected. Yes, asset value doesn't care the future. Then this is suitable. Sometimes you need to calculate the liquidation value when you close the company. So asset value is used when you liquidate the company. Next one is same company's study about the earnings value. So let's calculate company-wise earnings value. Okay. Company-wise net profit last year was $300,000. Then, if the cost of capital, or in other words, discount rate is 6%, and the company has the same profit each year for the next 10 years, and assuming no profits thereafter, then what is earnings value of the company? The calculation is shown this, So I don't explain in detail of this calculation, but the resulting figure is $2,208,026. This is earnings value of this company. But this earnings value doesn't take into account the 11 years and thereafter's long future profits. Only 10 years. That's why the number looks small. Next slide is same earnings value, but this example assumes that the company Y will continue forever. And then it generates the same profit each year for the entire future. So then, what is the earnings value of this company? The calculation is similar, but a little different, because you assume the year is forever. The calculation is like this. And then, I think you have heard the name of a going concern. Name is a term, going concern. Going concern means a company will go on with its business forever. So it's often used in accounting or finance. That if you think of investment, so you always assume that the company will go on forever. So usually the earnings value is based upon this idea, the going concern. So that's why we assume the company goes on forever, making revenues forever. Then in this calculation, I think you can find a very nice, good formula. That is a second line from the bottom. This one. Okay, the company's annual profit is $300,000, and then the discount rate is 6%. So if you divide $300,000 divided by the discount rate of 6%, you will reach earnings value of the company. So this formula is very useful. So please remember this. So this we discuss later again. So what is the characteristics of earnings value? Okay, one, so as a going concern, the company's future prospects and growth potential are taken into account. This is a kind of a definition of earnings value. But forecasting the future tends to lack objectivity. Yes, so this is like more subjective approach. So you need to be careful. Therefore, reasonable basis should be provided. So even you should be conservative in choosing discount rates or future profits. And this is used in merger and acquisitions and investment transactions. Case study of market value. Okay. Company Y has 100,000 shares outstanding, and its stock is currently traded at $60. So what is the market value? Okay. The calculation is not difficult. $60 times 100,000 shares outstanding is equal to $6 million. This is the market value of company. What are the characteristics of market value? Okay, very objective and comprehensively reflects views of all parties involved. Okay, we discussed this already. And only public information reflected, and inside information is not reflected. And used as a reference price in M&A deals. Yes, as in like in the Toshiba case, acquirer was looking at the market price, but he offered a higher price in its tender offer. The difference of the tender offer price and then the market price is called a premium. And then premium, in the Toshiba case, the premium was only 10%. But usually the premium will go up as high as 30% or 40% in the real tender offer transactions. And sometimes you need to calculate the unlisted company's market value. So in that case, you choose similar companies with similar size, and then their market prices are referred to. Okay, let's compare the three values of the company Y. As we calculate, the asset value is $3 million, and the earnings value is $5 million, and market value is $6 million. So what do you read from these comparisons? So in this case, the market value was twice as large as the asset value. And the market value is larger than the earnings value. So what do you read from this? Then I read from this like this. The company probably does not have an unrealized loss on its assets, or even company probably have an unrealized profit. So that's why the shareholders, investors appreciate with the market value. And also the company is probably in the growth process, but the investors in the market, expecting a more profit than the current level in the future. That's why the market value is higher than the earnings value. That's what I can read from this comparison. And there are good indicators, but there are ratios to measure the level of market price. The price book ratio, PBR. PBR is how many times the stock price is over the book value. Then this company's book value, PBR, is 2.0. The another ratio, which all often used, is a PER, price earnings ratio. PER of this company is 20, which is how many times the stock price is over the annual yearly profit per share. So PBR 2.0 and the PER 20 is a very good level and within the average range. So what valuation approach should be taken in which cases? Those are examples. When you look at the financial status of the company at the fiscal end, just you need the status, then you should look at the asset value. And when you think of acquiring the company, so you should look at the earnings value and market value. And when you want to sell your stock, you should look at the market value. And then when you think of liquidating the company, closing the company, then you should look at the asset value. And when you compare shareholders' valuation to that of another company, then you should look at the market value. And when you want to calculate the PBR, of course, that is, you should look at market value and the asset value. Okay. So page 36 and 37 is, I'm going to skip this. I think when you go home, you look at these pages. So this is another example of when you make a tender offer. So expecting a higher revenues in the future. Okay, let's skip this. Okay. Okay, please look at slide 37. In the last section, we discussed the legal context. So we will look at how these company valuations are considered and then discussed in the court cases. So that occur during mergers and acquisitions. In actual mergers and acquisitions, the focus is always the valuation of the company and stock price. In particular, if there are shareholders that don't agree to the merger, then there is a remedy, appraisal remedy, by which the acquirer purchases shares from those shareholders at a fair price. But the lawsuits often occur over that price because the shareholder wants a higher price, and then but the acquirer wants a lower price. So in the early history of merger and acquisitions, the courts did not have the ability to make judgments on the level of a stock price or valuation. And some fixed approach was taken in many cases. But Supreme Court of Delaware, this is a Delaware case. So Supreme Court of Delaware changed its previous practice in this case, and stated that the courts should be more flexible in finding a fair value of stocks in the individual cases. The fact of this case is like this picture. Okay, company A made a proposal to acquire company B, and company B's shareholder meeting accepted the proposal. But minority shareholders filed a suit claiming that the proposed purchase price of $21 per share was unfair. And there was two directors, who were common in company A and company B. So both companies, they were directors. And they knew that the company A had internal documents, and then that indicated an acquisition of up to $24 per share was appropriate. Okay, the judgment found that the two directors had breached their fiduciary duties. So because they were both company A and company B's directors, and they should have notified to the company B's shareholders that the company A had that document, and that document indicated the $24 is appropriate. So the two directors should have told the company B's shareholders of that. And then the court further stated that the weighted average over asset method, income method, and the market method, which have been persistently used for calculating the purchase price of shares, is inappropriate, especially in acquisition cases. And further stated that the discounted cash flow method, which is widely used in the financial world, has major implications. The importance of this judgment is that the legal judgments on the value of a company by relying on fixed method is wrong. So this is the same as what we learned today. We learned that each one has his own reason for the price. Each one has different valuation for the same thing. So that's why court said that only one fixed method is wrong. And the court further stated that the court should be flexible in applying company values that are fair to the parties, including advanced methods. So this case was the first case where the U.S. courts mentioned about the discounted cash flow method. On page 42, this is a quote from the judgment. This is what the U.S. court said. So let me read this. So where price obviously requires consideration of all relevant factors involving the value of a company, by value of stock is meant the true and intrinsic value, which must take into consideration all factors and elements which reasonably might enter into the fixing of value. Thus, market value or asset value, dividends, earning prospects, the nature of the enterprise, and any other facts which were known or ascertained as of the date of merger, and which throw any light on future prospects of the merged corporation, are all pertinent to the value of stockholders' interest. This is what the court said. Okay. That concludes my lecture today. But I think let's review what we learned today. Okay, we learned first section. We learned there are different prices for the same thing. In the second section, we studied asset value, book value, and earnings value, and market value. And next, we studied application to company valuation. And the last, we studied company value in legal context. Okay? So please take your handouts today, and then so remember what you learned today. On the last page, let me briefly introduce UJICY, where I work. That is Uzbek Japan Innovation Center of Youth. UJICY was founded in 2016 under the agreement of Uzbek government and Japanese government as an independent research institute. And the UJICY is located in the Tashkent State Technical University in Berlin. And we have 4 research labs of chemical, energy, and material science, and mining. And our activity includes not only advanced research and issuing papers and articles, but also conducting seminars and international conferences. And we have strong commitments from Japanese government and reliable partnership with Japanese universities like Kyushu University, Keio University, Akita University, so on, or Tsukuba University as well. And many Japanese professors come to Tashkent every year and conduct joint research activities with us. And many Uzbek students have been to Japan or are now being sent to Japan and studying in a Japanese university. And all of them get a master's degree or PhD in a Japanese university. And we have business relationship as well with industrial companies such as Almarik Mining, Bukhara Refinery, Uzbek Coal, and so on. And with our innovative technologies, so we solve their problems and meet their requirements. And we're also focusing on commercializing our technologies and creating new businesses. So I hope everybody of this academy will understand and be interested in UJICY. Okay. So we have some minutes left. So now, if you have any questions or comments, please tell me now. So we have some time. Do you have any comments or questions?
Good afternoon, sir.
Yeah.
I really appreciate your lecture. I found out it was very grateful, very helpful and interesting for me, and I hope for all of us. So my question is about the last case, which is we saw in your last presentation. So if you were owner of a company A, in that case, what would you have done with the minor shareholders who are unsatisfied and disagree with the price of a shares? What would you have done with them?
If I were a shareholder of a company A,
Yeah.
what should I have done?
Yeah.
Well, that's a little nervous, because company A didn't want to. I stand there. Company A probably didn't want to pay $24, so company wanted $21 because that is cheaper, right? But in this case, company A already studied internally that, and then the company A was sure that they could pay up to $24. So then probably what the company A offered to a company B, that is $21, is probably right, Probably that is the only way they could do. But in this case, there was a study in the company A that up to $24 they could pay. Then they wanted to hide that, conceal that to the company B. But the fact in this case was that there was a common director of company A and then in this case, actually, I didn't mention that, but the company A and the company B are related company. This is a parent company, and the company B was a child company. Then both companies are listed in the market. So then the lawsuit was occurred in the company B's minority shareholders. So that's why, I mean, to answer your question directly, the shareholders of company A was probably has nothing to do other than the offering $21.
Okay, so listen, my own opinion about this. If I were owner of a company A, I would have suggested to shareholders to remain or to stay to work for my own company A. Actually, to minor shareholders, I would have suggested to work for me. What do you say? Is it true or kind of correct, incorrect?
Well, that's not correct or incorrect. I said you could say that, and then it's up to the shareholders who agree to you or not. If he believes you, then so they will remain the shareholders and then join your company.
Yeah, I just wanted to hire them.
Yes, that's okay. But if he doesn't like that, then they will leave. So when they decide to leave, then so we have to give up appraisal remedy to pay buy out shares from there. Then the price was not $21, probably $24.
Thank you for answering.
Yeah. Okay. All right. Did I answer your question?
Yes.
Okay.
Yes.
All right. So, okay. Now let me explain the questionnaire on page 45. This is an electric with your mobile phone. This is a questionnaire. So please hold your mobile phone to the QR code on page 45. Then you will find a questionnaire there. And then please fill in. This is an anonymous name questionnaire. So your name, personal name, will not be collected. So we appreciate that if you answer the question, those questions. So it doesn't take long. So do you have any problem having QR code on your mobile phone? Or if you don't have a mobile phone now, you can do that? Okay, all right. So please don't forget to answer, within today, before you forget. Okay, then that concludes my lecture today. So thank you very much for listening for a long time. I appreciate that very much. Thank you very much.
Thank you very much.